Hi there, Dan Kurz, DK Analytics. It is July 14th, 2017. Thanks a lot for tuning in. We bring you this video update with a bit of a delay. I've been very consumed with a very unhappy state of affairs. The loss of a treasured feline friend that's been with me for 18 years. His name was Tigger. He was in tip-top shape, but cancer, that god-awful disease, took its toll very quickly, and I had to wish him a goodbye a week ago. So there's a tinge of sadness here in my voice, and I got to level with you. That's the reason for it. Excuse my personal note here, and let me dig in, if I may, into the matter at hand in terms of investments and valuations and other such very important stuff for lots of people. Especially important in light of the fact that we're running on fumes here. Again, the disconnect between valuations, these bubble valuations, thanks to financial repression of global central banks, be it zero interest rate policies or ZIRP, NERP, or QE. Even with this slight turnaround in the Fed, which we don't think is going to have any teeth, as mentioned about a month ago, I think it's a big show and is going to be doable because we're not going to reform our policy in the direction of supporting free market capitalism, sound allocations determined by the market, in other words, and property rights. And thus we're going to go off the cliff, if you will. But in the interim, we have confidence. We have tremendously high confidence that the central bankers and their puts will continue to support or levitate insane valuations of both bonds and stocks. And in a tertiary sense, obviously also property prices, which are also very interest rate sensitive. In the meantime, we have, as mentioned often, global productivity issues. The misallocations that come home to roost produce those, and we don't reward savers, we reward debtors. And despite all this and declining GDP growth around the world, productivity turning negative, ever bigger debt imbalances, global debt up over some $100 trillion in the last, since the beginning of the new millennium here, is flies in the face of asset prices, which seem to have a sustained disconnect with any sense of principal protection, capital preservation, purchasing power preservation, not to mention the attainment of real yields going forward, which is why you invest money in this first place, right, and forego consumption. Well, we think that perhaps the confidence in this, running on fumes valuations act around the globe could be pricked by something called pensions, or issues with pensions. We have dealt with this way back while I was a thematic strategist at Credit Suisse. I penned a lead article for the asset management division back in 2010 that is still available on our site here as the third report. It's called Demographics. It's a global issue. That my focus here will also be global because, frankly, we live in a global interconnected world, especially with valuations and central bank behavior and all that other good stuff. And I've also penned a piece last year in the post section of our site, and that piece is pension underfunding amidst ZIRP, NERP, and QE, or again, financial repression. But let me walk you, if I may, verbally through some of the issues here, lest you think this is an esoteric topic. It truly isn't. And if you still are fortunate enough to have a defined benefit plan where the onus on paying you your promised pension benefits is on the shareholders and not on what you've contributed, then look out below. Or in the case of states, which whether they're municipalities or cities or state governments or national governments, whether they're pension plans for state employees, government employees, or whether they're Social Security promises, all these things in essence have not been funded via sound schemes. In short, much less money has been put in and much less has been earned on it than it will ultimately be paid out. And that disconnect is getting bigger and more precarious by the day. And we're seeing more than just a couple rumblings, it's starting to spread. And this could, in our opinion, be something that could destabilize the bubble mania, asset valuation insanity in bonds and in stocks, and thus come home to roost, whether it's economically, financially, or politically, or all three. Let's just go through that, walk through that real quickly by revisiting some basics and also some history to give you an idea of why this is such a nettlesome issue. First of all, for the last 50, 60 years, we've had a sharply declining fertility rate. In other words, how many children an average woman worldwide basis has. That's gone from 5 to 2.5 children. In the developed world, OECD, from 5 to 2 kids. This since 1950. So we have big slowdown in population growth. In the interim, we have much longer life expectancy thanks to much more prevalent foods and medical care and technology. So more prevalent food and much improved medical care and solutions in that realm have extended the average life expectancy on a global basis. No, let's stay with the OECD world for a second. Has extended life expectancy from 67 years in 1950 in Western Europe, America, Australia, New Zealand, Canada, the OECD world, if you will. I think I mentioned Japan as well. Well, it's extended the average life expectancy from 67 years in 1950 to, in the OECD world, nearly 80 years currently. Now think of this. If you had pension plans and they were in existence and rolled out heavily on the heels of the Bismarck model in Germany after the post-World War II era came to a close, in other words, we're past World War II, we had people that had defined benefit plans. Again, the onus of payouts is on the company, on the shareholders, not on the individual and what he paid in and what kind of returns those funds achieved. And at that time, in 1950, if you lived on average only 2 years after getting your Rolex or your Timex or whatever it was, and you tended to stay with one company for your whole career, maybe 2 or 3, but you only got pension benefits for 2 years. So whatever politicians promised and kept it off the balance sheets, as they still do of government entities, it didn't really matter, because not only were interest rates much higher back then, 3, 4, 5% in the early 50s, but people were only going to live an average of 2 years after they retired at the age of 65. Compare that today with a landscape where the average age is not 67 that's reached, but close to 80. And compare that, furthermore, if you will, with zero or very low interest rates. Don't forget, pension funds invest about 40–50% around the globe into bonds in places outside North America, a dominating part of the mix, so even more pressure. But not only do we have falling fertility rates for the last 60–70 years and rising aging and thus calls for pension payments, but we have rising dependency ratios, which is related to obviously the other two. Meaning, in 1950, we had in OECD countries one pension off person with 10 workers working, if you will, on his behalf. And I say that carefully because he didn't really fund, as mentioned, in a piggyback fashion, an extended pension payout scheme, but it didn't matter because his life expectancy post-pension, being pensioned off, was very short, 2 years on average. Well, in 1950, we had one pensioned off person that had 10 workers in effect supporting his pension if he lived beyond 2 years. And don't get me wrong, I mean, all of us want to live for as long as possible, and it's a wonderful thing for everybody. So there's no way I want to get this message across incorrectly. I'm just addressing the funding and the financing aspects of this and what kind of impact, when this whole thing comes apart at the seams, may have on broader asset values. All right, that's where I'm going with this. So we have falling fertility since 1950 from 5 to 2. We have sharply rising life expectancy from 67 years to nearly 80, 79 and a half or something. We have rising dependency. A retiree had 10 people working for him at 50, and today he has four, all right? All going in the wrong direction in terms of funding pensions. And against that whole backdrop, we don't have interest rates, all right? So it makes it even harder, which suggests that the aggregate amount of assets you need to have to fund future payouts over a longer period of time needs to be much bigger. The net present value is much bigger the lower the discount or the interest rate is. You know, I mean, it's just common sense. If you barely earn anything, to set yourself up, if you had a piggy bank and saved this money, you would need a lot more money if you didn't have a decent interest rate to compound that wealth with. Tax-free in most instances because it's pension related, but still. So now enter politics into the mix. Right? Politicians post-World War II rolled out very broadly defined benefit schemes. Again, the onus is on not on the retiree and what he paid in, but on the shareholders, or if it's a public pension plan, if it's a government worker, or it's a Social Security kind of promise the government has made vis-a-vis its voters, and you've paid in payroll taxes. Those are defined benefit plans. And unlike companies, which were forced in a lot of jurisdictions to account for the actual underfunding of defined benefit plans, which grew and grew and grew as life expectancy rose and interest rates came down, governments didn't have to go there. They just did pay as you go. So politicians, of course, handed out promises, big fat pension promises, especially also to state workers, to people, citizens overall, in a form of Social Security guarantees. And all this stuff does not pass the financing test, i.e., if people had to save on their own, put their money into a savings account, got a couple percentage points, the amount of money they would have had to put in to fund an elongated pensioned off life, right, of 15 years instead of 2 years, turning 80 instead of just turning 67, would be, 4 or 5-fold of what they actually contributed and what those assets ended up earning in a declining interest rate environment. So it was easy for government officials to make these promises, in essence, by votes. Obviously, fiat money, the ability to run deficits at various levels, especially at the national level, but to a lesser degree at the state level, allowed for financing that otherwise wouldn't have been available. And there was no need before the aging baby boomers, my generation, really started to retire en masse to make too big of a deal out of this. And governments did stopgap funding. They also, together with corporations, had very unrealistic pension return assumptions, like 7-8%, even though bond yields are 2 or 3% nowadays, less than other jurisdictions and countries. So we in essence were able to, in government and in public corporations, publicly held corporations, keep an artificially high return assumption, which in essence go to people to invest into stocks which have run well, but at the same time, the risks of a stock market meltdown, which is overdue given valuations and the economy and building recession and negative productivity and all that other threatening stuff and the cyclical aspect of it, if nothing else. But what we have is a situation where pension funds were actually, it made sense for them to allocate to perpetually riskier assets, and thus they could raise their return assumptions. But those return assumptions of 7.5%, 8% have not been met, yet it allowed them to minimize both corporate and employee contributions to fully fund those plans at levels that would reflect the much higher return rates that they actually generated, right? So it's kind of a double whammy of insanity and financial recklessness. But as a result of all these things, we now are at a situation where municipalities or cities, such as Detroit, such as Chicago, such as the state of Illinois, and also in the backdrop states such as New Jersey and Pennsylvania and Kentucky, have underfunding that exceeds $5 trillion in aggregate. We go through this, as mentioned, in more detail in post 15 on pension underfunding, juxtaposed against the policy of financial repression. But it isn't just a public sector issue. We've got massively underfunded corporate plans as well. And the same dynamics are at work, yet corporations 2-3 decades ago in the United States started to shift away from defined benefit plans, realizing that no matter how much alchemy, no matter what a fudge their accounting assumptions were, which, by the way, the regulators allowed. They allowed them to keep carrying forward these ridiculous rates of return. And then they had a quarter within which they could be off for many years, then an amortization of underperformance and all this other happy stuff, which in essence has resulted in even greater pension underfunding, less contributions from shareholders and from employees, which is always politically popular, but puts us into this entire huge funding mess. So corporations backed away from defined benefit plans. Governments obviously didn't, because they didn't have to bring them on their books as underfunded. However, softly stated, those underfunded stances were in the corporate world. They at least got corporations to move away from these unaffordable plans into defined benefit plans, which goes back to a piggy bank principle, if you will, wherein what you get is what you were able to save and the interest or the investment income that you generated. And once that is used up, that's all there is, right? But the problem is, globally speaking, we have the G20 countries. This goes beyond the OECD countries, but if we look at G20 countries, and if we took their liabilities in terms of promises they've collectively made to people that are pensioned off, generally 65 or older, then, and I'm talking about government pensions for government workers, I'm talking about Social Security, and also Medicare promises, all right? If we throw those things all into the mix, the net present value of those obligations that G20 countries have is over 400% of G20 GDP. In other words, there's no way in hell it can ever be made good on, short of printing increasingly worthless paper currency with which to satisfy pension claims, which in effect is a slow motion default, but it's a default nonetheless. Let's go further with this and look at what I'm going to call crunch time. I mentioned Chicago. The year before it was Detroit. You've got bankrupt cities. You've even got a de facto bankrupt state of Illinois. Why? Because over the last 4, 5, 6 decades, they have increased promises to pensioners, to people that worked on the public payroll to such a degree, and at the same time underperformed investment-wise, and didn't ask for high enough contributions from either the taxpayers in this case or the state employees in this case. And they've got this huge shortfall. And at the same time, baby boomers, my generation, have been retiring at roughly 10,000 a day in the United States, with similar ratios than other OECD countries, probably even worse in Germany, Japan, and Italy than in the United States. So the pension funds, which have made all these promises that they couldn't keep, that they use stopgap funding, they took something out of the state treasury, they played accounting games, they're now having actual cash outflow problems in a relatively early stage where baby boomers retiring at 10,000 a day are going to continue this way for over a decade to come, right? For over a decade to come. So these claims and these cash outflows to people being pensioned off with pensions that were given to them that are way beyond anything they contributed, and the returns on the investments by the plan managers, by the pension plan managers, that would have lasted 4 or 5 years at best, right? But people are the piggy bank way to look at this. You get back what you paid in plus interest, put simply, right? But we're looking, as I mentioned before, at up to 15-year average life expectancy post being pensioned off. This is consuming an increasingly large part of city and state budgets, and they can't make expenditures for public works, for roads, for sewers. Those are being shunted or neglected. But even with that neglect and the crumbling infrastructure, that results in other issues because you're funneling the money to people pensioned off that have been promised much, much more than they ever paid in. You now have a situation where credit agencies have been actively downgrading municipality or city or even state debt towards the direction of junk or into junk, which makes their funding even more expensive. And what they're doing is they've been taking on debt to pay instead of taking the proceeds of those that have paid in for 30 years as being enough, especially the first few years, to pay them their retirement benefits. They're forced to, in essence, indebt themselves and or dip into the other people still paying into the plan. A Ponzi scheme is all it really is. But even all that isn't enough. And in the interim, you have outfits such as the Dallas Police Force and others that have smelled the coffee and know full well that in fact they're never going to get their pensions. So they want to use the option to take their funds out of the pension pool, which often ends up sales of the best performing assets, bonds that actually had a yield that are way above 100, which in effect strips the fund's ability to sustain a Ponzi scheme, right? Where people that aren't fully paid off or pensioned off are in effect paying out their future pension earnings or funds to those that are currently in retirement. Well, all this gets very ugly. States have to raise taxes. That's going to leave, or countries. This isn't just a state thing in the U.S. It isn't just an Illinois, a New Jersey, a Pennsylvania, a Kentucky problem. It's a Greece problem. It's an Italy problem. It's a Latin European problem. Given the global aging statistics that I just told you about, declining birth rates, fertility rates, rising life expectancies, and increasing dependency rates, or said differently, only 4 people support a given pensioned off person today versus about 10 or 12 in 1950. So this all comes to a head, and it means that people that have these pensions are going to see 60-70% cuts, or it means that states will find a way to convince the federal government, in this case the United States, and other relatively speaking sound federal governments, to step up to the plate and in essence bail them out. But we also all know that there are really no sound federal governments anymore, with perhaps the exception of a place like Switzerland or New Zealand. You tell me there, you can count them on one hand. And in fact, this very sobering statistic is best stated thusly. If you take a G20, right, as I said earlier, G20 liabilities vis-a-vis pension people, whether it's a government pension, whether it's Social Security, whatever it's called in the individual nations, and or Medicare, which is generally an OECD thing, the aggregate liabilities, if one discounts them back at these pathetically low interest rates, is the equivalent of roughly 400% of the G20 countries' GDP. In other words, it's unpayable. You can't make good on this, especially with all the demographic issues I keep mentioning, and obviously not with our financial repression-based monetary policies. So how do we sum all this up? What is the takeaway here? As this spreads, we could either face increasing civil unrest, as in Greece, potentially as in Italy, and other Latin European countries, or in America, in Detroit, in Chicago, in Illinois, if enough people realize that they're only going to be getting a fraction of what their defined benefit plans, the onus being on the taxpayer or the shareholders, that they thought they were going to get, we could really, especially in the midst of economic weakness and high real-world unemployment rates, whether you're in Spain or whether you're in England or whether you're in the United States, or you tell me, there are a few exceptions, but that's the rule, you might see this as political tender. And we know that politicians want to get reelected. And we know that central banks are, at the end of the day, politicians. They both want to kick the can down the road. They both love their power, regardless of the irresponsible policies, the toxic policies that they have furthered, thanks to the advent of full fiat money in 1971. Nixon cut the dollar gold standard. They've been able to print when in trouble. You can't live within your means. You don't have honest people. You don't have honest accounting. You don't live within your means, and on and on and on, right? So this is now threatening to come home to roost. We're going to see more and more of these headlines, and this could be the black swan that sets the whole thing off, meaning this could be the event or a series of people, realizing they only are going to get 30% of their pension or 40% that have defined benefit plans, whether it's state-based or even corporate-based. And by the way, corporations just in the U.S. have roughly $500 billion in underfunded pension plans. And let's not forget, those are defined benefit plans that really have understated underfunding thanks to political-based shenanigans trumping true accounting or accrual accounting, right? So when this all starts to perk up and recur, and it will, as people age and 10,000 plus baby boomers retire every day, and a cash drain on all these underfunded plans can't be hidden or kicked down the road or can't be papered over anymore, then we could have a domino kind of effect where risk premiums go up at the municipal and state level. They already are. It's hard for these states and municipalities to borrow because they have to pay junk bond rates, which kills them even further, together with tax increases that drives out the makers and the corporations. So this whole thing is a spiral down, right? And at the end of the day, if you and I know politicians, and because there is fiat money around the world, there is no more money that's tethered to the discipline and honesty of gold and silver backed above ground supplies, stocks, right? So inevitably, it's easier for politicians to print this problem away, to, in essence, pay off or large parts of pension shortfalls with money that is increasingly debased, right? And here's where we really get to the dangerous part. Not only are higher discount rates and interest rates on bonds going to upset valuations of bonds, and with time also stocks. Because as I've reported or shown you in posts, as anybody knows that's in finance or investments, valuations of stocks are very dependent upon the discount rate. They're tied at the hip with bond valuations in actuality, right? So if people demand higher risk premiums, in plain English, higher interest rates to entertain the risks of solvency. Oh, they can't make good on these bonds, Illinois is broke, or inflation, which is piecemeal insolvency. Your claim or your purchasing power gets eaten away over time by inflation, unless you enter hyperinflation. That happens very quickly. But people are going to be on guard. People that aren't going to get the pensions promised are going to be in an uproar. So you've got political uncertainty that's going to come up, especially in a lifeless economy, and high real unemployment rates, and also very high youth unemployment rates in many countries in areas of the world, especially in Europe and Japan and obviously the United States and Canada. But what you could have is all this come to a head wherein central governments and their statist central banker pals, elongated politicians, will just say the path of least resistance, meaning how we can keep our power, our inept trajectory, our toxic public policy stew, how we can sustain this and our wealth, which is expanding at the expense of Main Street. It's the cronies, it's Wall Street, and it's the quarters of power in DC and other capitals that are and the bureaucrats that are making out like bandits at the expense of the rest of the economy and of Main Street. But if central governments decide that the only thing they can do, central governments, central bankers, same thing, is to, in essence, make these pension claims money good, then the debasement, the acceleration of money printing that will bring with it will cause a shift in people's trust of the purchasing power of fiat currency, meaning they will see these huge solvency risks, they'll see all this money that's printed, or they will begin to feel it as we already have higher inflation rates that are posted. But what then typically happens is corporations move away from just-in-time inventory, where they try to maximize asset turns and generate higher return on equity, the DuPont formula. They will move to hoarding assets because they figure that what they purchase, their cost of goods sold, their raw materials, are going to be more expensive, not less. And people, investors and the general public, will move to purchasing scarce real assets. And often they're in the energy and in the food, agricultural patch, farmland, dense energy sources, things that you need that you can't print, but are essential to leading a normal and healthy life. Those tend to get bid up. They are great inflation hedges because you can't print them. And if those get bid up and the behavior of companies goes from inventory minimization to maximization, then all of a sudden the money multiplier, that you use to multiply the monetary base times the money multiplier, the proclivity to spend the money, the base money that's available, will take off instead of coming down. The money multiplier has been going down as people try to get out of debt, and you're off to the races in money supply. And we all know the classic definition of inflation. It's a monetary one. It's too many dollars or other currencies chasing too few goods and services. And that, ladies and gentlemen, is the ultimate recipe for a much higher, in fiat currency determined, gold and silver price, right? And it's a great recipe also for taking this information and moving at the margin out of overvalued bonds and stocks into safe cash. We have to avoid bail-ins because there's legislation in all major countries for if the bank management screws up, instead of them eating it, they're going to bail you in. They're going to take your funds, your deposits, your checking accounts, and turn them into equity. Good luck with that, right? And then they're going to have secondaries up the wazoo, and you're going to be diluted to hell. But you don't want to buy a bank stock. You want to have safe cash. Well, you no longer have cash that's safe if you leave it in a bank. And if you're going to worry about all the pensioners getting bailed out, if you're not one of the lucky ones that still have a defined benefit plan, you're either going to face a bail-in, you're going to face a big bailout of bankrupt pension plans, 5,000 billion in the U.S. alone at the state level, or 5 trillion, over 500 billion in corporate. It's a similar landscape in most of the rest of the world. So if you're an investor and you have a portfolio, you can't trust keeping your money or excess money in banks. You do what you need to keep there what you need to pay bills with, but get the other stuff out. Get the other stuff out. Get it into physical gold and silver, and also get it into treasuries where the government, you don't have any interest rate exposure. And if you're also still sitting pretty with huge gains on bonds and stocks, and you want to take some of those gains so you can repurchase them when the reset, when interest rates, discount rates are much higher, you will find stocks and bonds to be much more attractive, lower PE, lower, higher yields. So for those that bought, unless you bought 20, 30 years ago, then it doesn't really matter as long as you have blue chips. But if you bought more recently, it's worth taking those gains, parking them into safe cash, treasuries, or cash, real money outside of the banking system, and reallocating so that you're not only preserving capital, but you are going to avail yourself of dramatically better purchase opportunities in bonds and stocks, because as I've said often, we don't only have reversion to the mean, okay? In fact, we don't have reversion to the mean at all, other than shooting through the average valuation of 4% yield on 10-year treasuries in the US, or an average PE on the Standard & Poor's of about 16 times. No, we go from 28 times, 27 times, down to 8. We shoot through the mean. In other words, we overshoot. We have boom bust. We revert beyond the mean valuation-wise. And with all these dark clouds, whether it's political, financial, or economic, whether it's the loss of rule of law, property right protections, whether it's towering mountains of debt, whether it's on the economic front, lower growth rates, lower productivity, huge misallocations driven by central bankers over decades. In essence, started in 1971 when Nixon took us off the dollar gold standard. All these things suggest very clearly that we're going to have a major reset of asset values that will give you the opportunity for those that avail themselves of securing these bubble asset valuations. It's a gift today, and then backing up the truck and really going to town. Don't forget, no housewife goes in and buys because, Kleenexes are 50% higher than they were 2 months ago. They back up the truck, they go to Walmart's or wherever or to Aldi's or where have you, and they buy more when things are cheaper, not when they're more expensive. Investors should not forget that returns over time, strategic returns, are tremendously tied into underpaying, good strategic returns, underpaying for returns. Don't forget, Volcker Tough Love treasuries once yield 12%. Stocks, the other side of that, were down in the 6-7 PE range. They're just two sides of the same coin, and they travel together. And right now they're both elevated, and we don't have either the politics or the finances or the economics to suggest that they are money good, that you will get a good return, a real return, much less have security of either purchasing power or your principal, which could also be in jeopardy, either through outright defaults or piecemeal defaults over the slow grind of inflation, which can, if you end up having a crack-up boom, when people really lose confidence in fiat money, which could also happen, and go out there and buy real assets hand over fist, we could have a turbocharging increase in their proclivity to spend money, the money multiplier, married to these huge 4 or 5-fold increases in global monetary base, the balance sheet of the central banks, and whammo, your money supply goes off the charts and compared to the services and goods produced, and that is then hyperinflation. We could get it. I think we're going to get stagflation, the 70s variety on steroids. Yet again, assets, stocks, bonds, a lot of real estate, which is also interest rate sensitive, are priced for perfection and beyond. Yet we have the absolute opposite that is occurring. This is a huge opportunity to bring capital home, to place it into safe cash and other scarce assets and into real money outside of the banking system, precious metals, to position yourself for much better returns and an intact capital and preserve purchasing power while en route. I hope this makes sense. Thanks a lot for tuning in. That's all today for me on as I said, a sad day. A week after I lost a beloved 18-year-old companion that would sit, that would come to you when you called him, that would cuddle with you. He was like a dog that didn't need to be taken for walks. That's it for today.